Good morning, everybody, and welcome back to Schwab Coaching. It's our Wednesday edition of Trader Talk in today's market. And I'm your host, Kevin Horner. It is a still, as of yet, chilly morning here in Denver, Colorado, but nonetheless, a beautiful day on deck. Happy to be here with all of you. Take a brief moment and say hi to my friend Cameron May in the chat, who will, of course, be keeping an eye on postings there. I'll obviously try to do the same and answer some of those good questions that you all have for me. So happy to get to those and a number of other comments and details today. Have a lot of individual equity charts we're going to look at today. Turns out our friend Brent Moores is on PTO today. So as a result, I will be here solo with you. But we're going to utilize that opportunity to hit up a lot of individual equities that we didn't get to yesterday. I had a number of key upgrades and downgrades, some stocks in the news that I wanted to address and look at the charts of. And that's what we're going to do this today, specifically in the better portion of the segment. So, of course, we'll start off broadly and then get into all the fun stuff with you guys. So thanks for being here, everybody. Take a moment, and if not already doing so, follow us on X. You can do that for Cameron, at Cameron May, CS, and I, of course, am at Kevin Horner, CS. And if you like the content today, it really helps us out quite a bit. If you hit that thumbs up button down below, helps us in the YouTube algorithm and also makes things available a little bit more clearly for those who get to see this show on a rewatch basis or the archive basis, as opposed to those of you who are lucky to be here with us live. So thanks for joining today, everybody. Let's go ahead and check out our disclosures, and then we'll get into the fun stuff. Of course, remember that our discussion here is exclusively informational and educational. What we mean there, of course, is that we do not make any recommendations nor endorsements for a particular strategy or approach to trading the market. It's also important to remember that while we talk technical analysis here quite a bit, technical analysis should not be the sole means of your decision making. We think it's a piece of the puzzle, can absolutely help you make your decisions along the way. But as always, we have multiple pieces that paint that picture for us. So we encourage you to utilize as many as possible when basing your decisions, of course, but not exclusively based on technicals. Okay, let's take a look briefly at the agenda. Like I said, we're going to hit the major indices. There's been some good developments here today as a result of a CPI that came in line on the heels of yesterday's tamer PPI. So that's going to give us an opportunity to hit up the major indices before moving in to check out these individual equities that may very well be getting a little bit of a lift today collectively as well. But of course, we do that in that top-down methodology, starting broadly, large cap, small cap, etc., working our way down the spectrum into the 11 sectors of the market to try and gain an understanding of what's really working and what's not. And that can help us with trade ideas too. Remember, when you're thinking about placing your individual trades, many traders will give consideration to the cap-weighted starting spot. So is this a large cap company participating, for example, in the S&P 500? Is it a company that is then in a sector that is also in an uptrend? These are things that can be incorporated into your process a little bit and help you weed out the securities that might not be the best opportunity at a given moment in time. So one of the things that we try to talk about here quite consistently as well. So with that, let's get to it. We'll take a look at the S&P as we get started here this morning. The move upward is notable. Great green candle. We talked briefly about this yesterday. What did we want to see from yesterday's candle? We wanted a close above the high from Monday. Monday's high was 58.38 and yesterday's close was 58.42.43, let's say. So we closed above it by about 5 points, but there were some times during the day yesterday where it was fairly unclear as to whether we were going to get that, right? As you can see, that's a fairly long tail. We worked our way about halfway down yesterday's candle at points, and yet we did finish strongly, and that gave us the so-called close above the high of the low day. Now, we got a continuation move on today's CPI number. As I noted, it did come in line. Expectations were for 3.2%, and we can, excuse me, let me take a look at this a little bit more clearly. The rate was at The annual CPI rate, the core that is a 3.2%, slightly down on a month-over-month basis, but better than the expected 3.3 outlook. Now, sheltering prices, those make up about a third of the CPI weighting, did rise a little bit, still happen to be up about 4.5% from a year ago, but it is the smaller gain that we have seen in that space relative to shelter over the last 12 months. So that, or excuse me, the smallest 1 year move in shelter increase that we've seen in actually more than 3 years. So that does mean that while sheltering prices continue to increase, and unfortunately, it's a possibility that we see that continuing moving forward, it is the slowest or lowest increase we've seen in the last 3 years. So we can take that as optimistic. But when we start talking about the trend stuff, again, everybody, you heard me say it quite a bit yesterday. We are still in the midst of a short-term downtrend, and we can't say that that has shifted until we move through that downtrend line. So we have a couple layers of upside resistance that can pose opportunity for long side sellers of the SPX to take their risk off. Where might they do that? If you're a trader who had the guts and the gusto to step in on the gap zone low here on Monday, then you're looking at the 20-day as a potential pause in this real quick rally back, right? That's one option. Where's option two? Maybe it's the 50-day. And then option three becomes the downtrend line. And some of you may choose to layer your exit strategies at those various levels. See if you can get taken out on an exuberant move to the upside, an intraday move that affords you the chance to capitalize and sell small portions as things are kind of running a little bit. Remember, when they run, it feels like they're going to continue to run and never give you the chance to to add or to breathe, right? But we know, we've been watching the market for a lot longer than a few days. We know that what goes up does pause. It may give back a little as well. These are the things we have to keep in mind. Try not to get too far ahead of ourselves and overdo our thought process a little bit. Let's put everything back into perspective. We're looking at a one-day chart covering, in this case, just the last 6 months or so. But ultimately, remember what a one-day chart is. For a lot of the time, a one-day chart is a daily look at things can be simply noise relative to the overall longer trend. But we're getting some wonderful positive developments on today's CPI, but I just have to point out, have not done anything to break that short-term downtrend just yet. We'll feel a lot better as we see price action over my red line, which I'm just going to take and extend a little bit further. And remember one thing about these manually drawn trend lines, everybody, you can manipulate them. You can move them around as needed. So when you start to move into them and they act as resistance, that starts to tell you a little bit of something. And if we actually get breaks, then we want to make sure we change that red to green. What was a resistance line could become our support line. So good feelings today. Let's see how this relates initially here in the NDX. Nice 1.3% move in the NASDAQ 100. Good bounce off that this falling wedge essentially, but nonetheless, we still keep staring at a number of key levels that we got to get through that are going to tell us that things are a little bit better than we have seen. So what we're seeing here today, similar to what we got in the SPX, right? A close above the high of the low day with yesterday's close at 20,757. High from Monday, 20,007. Oh, excuse me. Let's back this up. Maybe I missed, my eyes are deceiving me a little bit. Yesterday's close was 20,757 and then the high here was 20,797. So we actually didn't get a hold day yesterday. Technically, if we hold today's move, then we would have a close above the high today. Now, this really quick rally has pushed us into the 50-day moving average. We are now 4 days below the 50-day, and yet we've also got the down-sloping 20-day above us, right in the neighborhood of 21,300, and we have the downtrend line to worry about as well. So, positive from the setup standpoint, and yet the concern is that we still, like in the SPX, have those higher lows, lower highs and lower lows. What we want to do to mitigate that or to change the visual on this, even though we just made a lower low, we got to make a move through this horizontal zone, which could easily be a level of substantial resistance. A move through this red line, everybody, is going to make this look like a continuation move. So that's what we're looking for, right? Could this be, and this is a good question. Yeah, C Bravo. Is this a buying opportunity for the bears? And I think ultimately what you're talking about is, do we position ourselves with downside targets and whatnot? Sure. Much like we would say if you're sitting on a major moving average, you're looking to be a buyer at major support, well, you could be a seller at major resistance. Is the 50-day going to provide that here? That's unclear. But if you were a bearish trader who felt that the action of the last 4 days was the most important factor, well, then maybe that trader says a move through the 50-day moving average to the upside by either a close above it, maybe a series of closes above it. That might be 2 days in a row, 3 days in a row, closing above the 50-day. That could maybe invalidate a bearish position or make a bear a bit more uncomfortable. But some traders would just start working against that 50-day and position that way, position bearishly based on that. However, you got to keep that small if that's your viewpoint, because there still exists the possibility that instead of the 50-day, it's the 20-day that acts as resistance, right? And if it's not the 20-day, what if we moved to the 20-day and found resistance at this downtrend line instead? And then that takes it, maybe that's a little bit higher still, okay? So as always, whether you're feeling bullish or bearish, regardless, make sure you have that plan. So you might be on the right side of things here, C. Bravo, but at the same time, we don't know. And so as inevitably, we have to prepare as though we could be wrong, right? And we know we could be wrong because that's the way the market works. We're very rarely right all the time, right? So we want to be disciplined in that process. Take your position, take your risk. If you're feeling confident, go ahead and do so. But recognize that the truth is, while we have price action banded between my two white lines here, really the move outside of those white lines is where we're apt to get the biggest move. Anything that happens in between it right now could just be limited in scope. So what I would say is, could be bearishness, sure. But obviously a day like today, on the heels of an improving CPI number and a clear narrative that would suggest that the market was excited by this report, I think it would be a challenge maybe to take bearish positions immediately, given the enthusiastic rally we're seeing off the jump here. So maybe a little bit of caution as it relates to that. Okay, so there's a quick look. S&P 500, NASDAQ 100, both up nicely. What about the Russell 2000? The Russell's our leader here today. We're up 2.25%, and we might be in the midst of something a little bit better for us here, right? We have a break of the 20-day moving average here. Now, I know I've got a lot of lines drawn on my Russell, but it's because of what we've been watching with the Russell for so long. So let's clean it up. Let's just go ahead and let's just kick everything out. I will clear the drawing set and try to make this as simple as possible. We are back below the 20-day for the most of the last 6 weeks, and then today's action took us through it, okay? So if you're utilizing today's narrative and want to believe in small caps, some traders would use the low of today or the 20-day moving average or some semblance of that, maybe an average true range amount below the 20-day to set risk. That might make sense as well. But if that's your belief, if you're a believer that the 20-day is your greatest opportunity, well, today might be that day. And again, reminder that just because we're above it at this point of the day doesn't mean we're going to stay above it for the remainder of the day. How the stocks, how they close today is going to have a lot of impact on how things look, of course. But another key component to the Russell chart is going to be the prices that we've rallied to and failed at recently as well. So there's certainly some horizontal resistance in this area. And if we could sneak through about 20, that's that 2,300 we've kind of been talking about, right? Let me extend this to the left. And then I'll just point out the instances where we have been there have not been insignificant, right? So we've seen this. This has been consistent for us. And what we want to do is just recognize that what has been consistent until it's not, right? And so here we continue 2,300 as potential resistance. We want to get through that, and that's going to give us a bit more confidence here in the opportunity as it relates to the Russell. So right now, great move, but a little unclear. Now, why are we getting this move? Yeah, it's certainly the CPI, but let's look under the surface a little bit here. CPI comes in at levels expected, and then we've got the dollar index selling down a little bit, so that's giving the broader markets, or at least our multinationals, a little bit of a short-term lift here. Let's keep an eye on that 20-day moving average, because the truth is we've been in a very strong US dollar trend since middle of last September, and the 20-day has been supportive along the way with mere short-term bouts below it. The trend does maintain even here. So while we're getting that one-day fantastic move, or really a 3-day bounce off the lows from Monday, let's, again, not get too far down the path in believing that we are going back to new highs. We have to take those stair steps, right? Remember that we're not going to just go all aggressive to the upside until we start taking out layers of resistance. Now, how about the yields here? Let's check out our 10-year rate. Get that in there. Pulling back nicely as well. What does this tell us? It's telling us, as Kay Brown is pointing out, it's all about bond yields. We are seeing buying of U.S. Treasuries suppressing our yields, and that is helping us out. So you're finally getting, whereas previously we've been getting a lot of selling of U.S. bonds, here we're getting buying of U.S. bonds, and it's pushing the U.S. Treasuries, that is, and it's pushing our yield down a little bit. Now, from a technical standpoint, what are we getting from the selling other than a retreat to a zone of potential support, right? So we'll have to monitor this. A break through that 4.6 zone, everybody, that could be the impetus for moves continuing to the upside. So if you're looking to balance the idea that the S&P can continue to run, well, it's likely going to have to go inside with a continuation of the selling in the US dollar and a continuation of buying in US Treasuries, and thus a fade in the rates on the 10-year Treasury. We'd like to see those yields continue lower. That'll give us a little bit more confidence and comfort. Speaking of confidence and comfort, you'll notice the VIX continues to push lower. This is a positive, and the market's going to continue to point to this. The lower we get, we're still feeling a little bit elevated with earnings coming here on a number of companies, but the fact is we're at a much better rate than we were just on Monday at the open, as you can see. So keeping an eye on the VIX, yes, it's a little bit elevated. We'd prefer that to be under 15, but where we are right now is certainly an improvement over the last 3 days. All right, another big space, the semis. Semis have continued to maintain the triangle here, as it turns out. Yes, we tested lows. Yes, I could redraw that line, maybe just capturing these lows. There we go. And now everything looks like it's perfectly within order. Do we use this as our chance to challenge the same line we've been to a number of times? Probably want to change this to red, just as a call out of what it really has been for us. Substantial resistance. We have been there a number of times. We have been kicked back, each of them. So we're going to continue to keep an eye on that. But the improvement in the transports after a fantastic, we talked about this just yesterday, after this 3-week consolidation here is really, really nice. Like the fact that we've gapped again, so we've got these 3 beautiful candles, but let's keep an eye on that 50-day. We are possibly into the gap zone. Today's high took us to basically the bottom of this gap right before we gapped on November 5th, or November 6th, that is, post-election, which continues to be significant, not just for the S&P and the NASDAQ, but clearly on the Dow Jones transports here as well. All right, so wanted just to cover your bases as it relates to the broad stuff. And then I thought, as I haven't done this in a while, everybody, I wanted to bring over my sector grid, which is essentially, if I kick it off of my sectors, really it's an SPX chart with all of the 11 U.S. sectors as well. Each of these providing you a kind of a snapshot in time. And this is one way that some traders might look at it. I find this to be a little bit small visually. So I like to maximize my sells and then use my arrows and just kind of flip through and see what captures my eyes. And obviously here we've got energy pushing. Energy's been on a really nice move, right? So you can see the significant development at our double or matching lows back here. And we've pushed this now through the 200-day moving average. This is starting to resemble, a much more bullish intermediate term trend. So that's nice to see from energy. We can do something similar here. Notice materials makes that move today, maybe back up above a major zone of resistance. We'll see if that maintains. We've got here the industrials, which we talked about yesterday. Similar scenario playing out here as we get to a potential zone of resistance, potentially the 50-day moving average there and coincident with these last lows. So that bears watching. But the takeaway here is a lot of these so-called downtrends or short-term downtrends might have been broken, and then some might be at major important levels of resistance. How about the discretionary group here, everybody? That downtrend line is covering today's price action. You can't quite see it, but this is a bull flag drawn in, and we have rallied right into the 20-day. Now, haven't yet necessarily, if you're a trader of a bull flag situation like you see here potentially in the discretionaries, you haven't necessarily gotten that right. We haven't seen a definitive clear or break of that downtrend line. And many of you are going to wait for it to be a close over the 20-day. Some would start a position on a single day close above the 20-day. Some would wait for it to make a new short-term high, which would be over this 1888 level. 1878 level, excuse me. But again, as always, you don't have to do the full position thing. A lot of traders like to step in a little more slowly or utilize their level of confidence to dictate just how much position-wise you're putting on. So I often say it's perfectly fine to step into these positions a little at a time. But I'd prefer, or would at least encourage you to think about setting those levels and being definitive. And what I mean is, don't go with an approach that says, sometimes I might buy 5% and sometimes I might buy 25%. My encouragement would just simply be have a process that makes it easily repeatable. And so if your small comfort idea says that you only want to try a 25% position, perfect. Carry that forward on all of your small comfort trades. Your bigger comfort trades, maybe that's half of your initial position. And then on a new short-term high, you add the second half. That's just one way to give thought to it. But the most important aspect about that is to have that process, lay that out quite clearly so that you have the framework and what I like to call the playbook so that you know exactly what you're going to do when the market does what it does. The market's going to do whatever it's going to do every step of the way. It does not care about you. It does not care about me. It doesn't care that we owned that position in the past. It doesn't care that we made or lost money on that position in the past. That's why our process has to be nothing short of pristine, really. Consistent and discipline is where we get the greatest opportunity. Okay, so discretionary still moving, not really yet breaking, but got to keep an eye on it. And I'm going to share this with you all because, again, I think a grid like this can go a long way towards helping us understand where our opportunities lie. Let me ask you all, looking here at this Staples chart, seeing we have that banded range here that we have now fallen through, looks about 2.5 weeks long. We've been below it. You're getting a bounce today. If you're bullish, are you really thinking that this is your chance to buy back into a group and that is dying to get back into the range we just fell from? Or is this simply a short-term scenario that's going to bring you maybe into resistance? And you know what? My thinking is we've broken a major zone of potential support that stands out, and we've seen a pretty darn healthy selling, right? I mean, my goodness, that is speedy and aggressive. So that line tells us that by itself, just from that most recent peak, about 7.5%, that is significant from a large group. So I mean, this bears watching, obviously, but I think a lot of traders are going to look at what's gone on here now in the last couple, 3 weeks and say that they are not going to have comfort buying staples based on all of this action below the 50-day, below the 20-day, below the 200-day, and below former support, now potential resistance. So we got a lot to monitor as it relates to the staples. Yes, I can share this. I'm going to share this with you guys. So let me just take this grid, I'm going to share grid right here. I'll put this into both the notes as well as into the detail on the archive. So if you're catching this in the archive, everybody, check the show notes down below. You're going to find this grid link in there. Remember, this grid link is not a recommendation for use, just an opportunity for your consideration. And I can't guarantee it for its accuracy either. But you know what? If you're looking for a way to go about monitoring the major the sectors, this is one way that some traders might find that to be quite helpful for them. Let's see. I want to go back to that grid quickly. Let me just go run through a couple of more, and then we're going to get to some stocks in the news. So as you can see, we're only halfway through that grid, everybody. I thought staples was intriguing. I think healthcare remains notable. I won't say intriguing just yet. It's above the 20-day is kind of standing out. Had a really great candle on the 20-day moving average just yesterday, so maybe healthcare is making some semblance of an improvement. Got a lot of work to do. Here we got financials finally making a nice pop, getting back into the 50-day moving average. We'd love to see that candle look like that today at the close. I think that would be a scenario that bulls are looking for. Notice, not only right now is it trading to a new 1-month high, if we go back in time by about a month, that is a 1-month high here on financials. We're also seeing the RSI moving into what would be considered overbought conditions in a downtrend, but could also be considered to be continuation indication in the midst of a long-term uptrend. And I think you could suggest that this is exactly that, a long-term uptrend, beginning from the lower left to the upper right. We still have that working out pretty well, right? All right, that was financials. Technology bouncing off a good support zone, but we are below that ever-present 50-day moving average. Today is day 4 below that 50-day, right? So we're going to keep an eye on that one. And I think the fact that we've seen price action like this dictated below the 50-day for 4 days, potential for that to end today with a really wonderful push through the 50-day, but it seems like that would be a little bit of a challenge. So keep an eye on tech there, but an improvement, but a good bounce zone potentially here with the level that we just tested on Monday. And then communications holding up, but also kind of quiet, but positive being that it's not given back, right? So a lot of traders will tell you in the midst of deeper pullbacks in the broader market, if you get some sectors that aren't necessarily going up, but are also not going down, that is a positive as well. This is going to be one of those relative strength outperformers, it would seem, at the moment at least. So keeping an eye on communications there. And then we, of course, get to our interest rate sensitive groupings. We are seeing utilities climb today as rates fall. Obviously there, the thought process being we don't have the so-called risk-free rate of return with treasuries because they are dropping a bit. So you might see a flight to utilities in the very short term. And I say very short term, we're talking the daily charts, not anything as of yet more significant. And then you can see the same thing. Let me eliminate these lines here real quick. Probably see something similar in the real estate, the REITs. The difference here being that we remain or are actually failing at the 200-day today. We'd obviously like to see a trade above that white line. That would give us some validation. So that would be favorable if nothing else, but that doesn't mean we're going to get what we want, obviously. So, all right, everybody, let's get some stocks of the news here. I want to take a look at a few of these that were on the list for yesterday that I just didn't get to with you all, so I'll apologize again. But we had a couple of interesting ones. In fact, Seaport Research analysts upgraded one stock in the financial space and then downgraded a counterpart, which I'm always intrigued by. So they upgraded Visa to buy from neutral. This was just yesterday, and the stock gave us one of those doji days where essentially the close was equal to the open. But the big day was really on Monday in the sense that we almost tested that gap level. In fact, I could probably just put it in like this. There we go. Right around that 303 level. So you could say that the gap was tested and maintained. And then today, you're getting continuation above the 50-day and at the 20-day. So some traders, look, if you liked the 50-day, not a lot of traders would lean into the 50-day necessarily when you could consider being here at the horizontal support at 303. The difference between the 50-day and the horizontal ledge is only about 8 points. And that's less than 3% on a $300 stock. So some traders might just choose to go with smaller position sizes so they can maintain the position as long as it holds on to about $300 a share, right? That gives them some wiggle room. But because they have more wiggle room in price action, those traders need smaller position sizes to manage the risk, of course. So one way for consideration there. But oddly, Seaport decides to upgrade Visa while downgrading MasterCard. That always kind of stands out to me. Now, the trend here, they're not looking a whole lot different, except for the recent bout of selling from MasterCard, which seems to be a bit more of a trend break. So this could be, and unfortunately, the Seaport didn't give us a lot to work with here, everybody, so I don't have more notes on it. But I thought it was interesting nonetheless. They like Visa. They don't like MasterCard, evidently. Another one in financial that got upgraded yesterday was from HSBC, and that was upgrading Capital One Financial. A lot of these financials going to look good today on this move, of course. Capital One got upgraded by HSBC to hold. It had been at reduce, so essentially a sell rating pretty much. Previous target here, or excuse me, current target on this one is 176, but the development today seems kind of interesting, and that is the break of that downtrend. It's going to be a little more obvious when I draw it in there. There you go. So for a lot of traders, everybody, it's the break of the downtrend line that gives them the reasoning to be stepping in initially to a new position. Again, thoughtful entrance, right? Not, okay, we broke the downtrend line, therefore I'm just a buyer. Am I a buyer of a full position on the break of a downtrend line? Am I a buyer of a portional position on the break of a downtrend line? What is your process? What is your preference? If you're a portional buyer on a break of a downtrend line, where do we see those traders tend to add to a winning trade? Remember, it's perfectly fine to start small, and then once your theory or thesis is proven to be somewhat accurate by a continued move higher, many traders will then add to a trade that's already working. Well, if that's the process, where might that trader consider doing so? For many traders, it's going to be closing above that last high, in this case, 198.30. So if we got a close over 198.30, some traders would say, all right, that's a continuation. I'm going to add to this trade now. I put on 25%. I'm going to add another 25%. Or because the stock moves to new highs, maybe they add 50% of what they ultimately want. But whatever the case, have that plan, refer to your playbook, and get yourself the steps necessary so you know exactly what you want to be doing. I see we have a survey opportunity there in the chat, everyone. If you don't mind, I'd love to hear from you. Always love hearing from you, everybody. Take a moment to spend 60 to 90 seconds and let me know what you think about Trader Talk in particular. I'd love to know what things you'd also like to see me address here in the segments, maybe particularly those solo sessions, which traditionally are just the Tuesdays. But when given the chance, I'd love to bring you all new ideas or educational topics that you're looking for. So that's where you can take that survey and let me know those thoughts. Those come to me directly. So 60 to 90 seconds is all that's going to take, everybody. Okay, how about some downgrade calls from yesterday? We had one on, boy, I'll tell you what, it was on Las Vegas Sands, LVS. The sector here, this was I'm on the weekly, I've got to go back to my daily. So this one has been working really aggressively lower here in the last month plus. We had peaked at 56. We had taken out the midpoint of this trend, and you'll notice that was at 48, and we almost 48, really 47.70, and we have continued the slide since then, right? Not great. Some would say, oh, well, we're just going to slip to the 200-day moving average. We'll hold on there. That hasn't continued either. In fact, notice volume in the selling is up sloping. So there has been a pickup to the selling, and many traders have to call out the fact that we've also got an RSI into oversold, legitimately oversold conditions, right? So here we go with a RSI under 30, that is oversold, but remember, oversold does not imply overdue for a bounce. So that is a significant move. You might get a short-term bounce, but oversold conditions under 30 tell us that maybe we are in the midst of a new and maybe a formidable downtrend in this case. We'll see if that plays out, but maybe watching the level from which we fell as support, as potential resistance in here. If we find ourselves staying below this area, that could be problematic for the position. So let's just make that red. Let me give you the details on LVS. It was Morgan Stanley that downgraded Las Vegas Sands, downgraded them to equal weight, previously at overweight, target here at $51. That is down from the target previously at $54. So yes, 51 would be fine. That is the 50-day moving average currently. Any bounce into that would be surely nice. I mean, a 51 level would be better than 10%, obviously, but you're gonna have to take some stair steps along the way, right? So let's do that. Hopefully we can. All right. How about, what else do I have in here? Some news. Wanted to make sure there was a couple of price target ahead of their quarterly results, some upward revisions on Netflix. Thought we could look at that real quick. These again were from just yesterday. Netflix has been under a bit of pressure here, as you can see, broke the 50-day with conviction on Friday. Seems to be setting up, either letting us know that the new short-term lows are held here, and that would be fine, but it also has the resemblance of a bit of a bear flag in the sense that we have continued lower, have consolidated. We'd like to see this not fail up here at the 50-day, but that seems a little questionable. I wonder to a certain extent if maybe we are sitting on another moving average. We're below the 20, we're below the 50, we're above the 200. Where would the 100-day moving average be in relation to this? So let me just bring up my tools and let's see if I can put on that 100-day. Okay, so we're not even at the 100-day. So that's about a 50-point move. Boy, that doesn't look like 50 points, does it, everybody? We have been above the 100-day for a while, going back to August. So this one kind of stands out. We had a one-day test of the 100-day, and it's not been necessary. But I'll tell you what, if we slipped and found us bouncing at around, say, 790, 795 or something, coincident with that 100-day, that wouldn't necessarily be a shock. But if you're a short-term trader, you have no reason to think it's going there necessarily until we take out the lows we just made over the last 3 days. So yesterday was the low trade in this pullback. So a close today over the high from yesterday. So let's say 845. That might be what we want to see out of Netflix. It was Barclays analysts that raised their target on Netflix. Previously, they'd been at 550. Seems like they're a little slow to the game. They've been maintaining an underweight rating on the shares, but they've pushed the target to 715, maintaining an underweight rating on the shares. The firm says that in order for Netflix to keep working to grow its valuation, either revenue growth or the margins will have to come in line better than companies' guidance will. It says it's not going to be easy for Netflix, but they believe that they have the best content cycle and high multiple and the maximum benefit from paid sharing and margin benefit due to the strikes last year. So sets up favorably according to Barclays. Let's see how that goes. Of course, we have to bear in mind earnings coming here on the 21st. That's less than a week away, everybody. All right, couple more here for you today. Let's see. I had a downgrade in the home builder space. We're going to take a quick look at home builders once more. We're getting a bit of a bounce. I got to fix my chart. Let's go back and get all those details. Oh, I did see. Let me give you guys something. One question here I saw in the chat that I wanted to use this to answer. So we had a question about return data, I think, on your chart. And I wanted to give you all a grid that might offer that. Let me see here. Well, I can't quickly find it in my notes, or rather in the chat, but I am going to do this. Let me, I'm going to put up a set of studies that incorporates the return details. There you go. Now, this return details are for the S&P, or excuse me, for the individual position. And then it's also going to give you the break of stocks, the breakdown of S&P stocks above the 200-day simple moving average at the same time. So, for example, if I put on here Apple, you're going to get the Apple details. That's the first ones. Year-to-date change, month-to-date change, week-to-date change, what's the PE ratio, the dividend yield, the payout, etc. And then the move off of its 52-week low, 52-week high, etc. That's kind of some intriguing stuff. But the reason I'm going to share it is when you look at the return data here, everybody, that's what this is. This is something that you can dictate yourself. So I have found that by knowing what those details are and then utilizing the gear, you can make changes right in here. Okay. So, yield, do you want to see the yield? Yes or no? Do you want to see year-to-date, month-to-date, week-to-date return? Yes or no? You can make some alterations here, and you can also make a change to the label coloring in here as well. Mine is set to gray. You can make an alteration there. So give some thought to that, everybody. Maybe play a little bit with these available alternative studies, if you will, and get some of that criteria added to your chart. So I'll go ahead and I'm just going to save this grid. Remember, my grid is still a 1 year, 5 minute, or 5 day, 5 minute, 1 hour, and then a weekly. But on the daily chart specifically, it has this return data. So I'll save this, or rather share this grid with you as another option for you to check out. So maybe some of you will find that to be helpful. There you go, everybody. All right. So the last thing that I was mentioning was a report that we had on KB Homes. We were looking at the home builders, which are a bit under pressure, but with rates falling today, probably improving a little bit. The headline we had was on KB Homes, and they were getting a upgrade today out of Seaport Research, upgraded KB to neutral, had previously been at sell. They did not provide a price target for us on KB Homes. Says that Q1 is stable. Gross margin guidance was not expected, and it distinguished it from its peer group, according to the analysts in their research note. So the firm says the company is less burdened by rising existing supply and has backlog visibility, which supports their upgrade to neutral. While it's concerning that macro catalysts exist with higher rates, rising new home supply nationally, they think that Seaport, that is, believes KB Homes' regional mix better positions them than their peer group. So hopefully that'll help out at least that space. We have been talking a little bit about home builders for the last few weeks and months, and we've talked about the downtrend that we've been witnessing there. We have also noted a number of key downgrades in that space. So to see one, albeit one company within that space catching a potential upgrade here, that is not a negative. We'll take what we can get. Definitely a difficult space of late. Let me answer some of these more questions. Vic, no, when you import this grid, it's going to open separate of everything else you've done. If you click that link that said, put a check mark in when you do this. So when you hit preview, make sure you just put that check mark and then it will open that chart separately. So it's going to open the whole 4 chart grid. separate. You can save it separate, delete it. You can then reopen it, position it as you like, utilize those details in the study, and maybe apply those details to other charts you might be looking for. Hopefully that's helpful. But no, it won't override what you've done. It'll just be opening up another opportunity for that chart. Like the label, yeah, absolutely, Dan, you're right. This is one of those where these labels often come from our man Ken. He was so good at this stuff. Really, really positive. And yeah, we miss Ken, obviously. All right. So yeah, it looks like I got to what I could today, everybody. We're going to wrap it right there. Boy, you're right, Will. They do go quickly, don't they? We are at time. So more to come from us here on the Schwab Network. Keep it tuned to the Schwab YouTube channel. If you're not already doing so, please make sure you're subscribed to the channel. Follow Cameron and me on X, Cameron May CS and Kevin Horner CS, and hit that thumbs up button for me down below as well. And don't forget the survey. I'd love to hear your input, everybody. What did you like about today's class versus others? Let me know what you'd like to see from this. I would appreciate it. So thanks again for being here. Have a fantastic Wednesday. I look forward to seeing you all again real soon.